Okay, I'm very sick. I will try to get through this video. That's why I have not been making videos or doing anything much of lately for the past 2 weeks. I have rashes all over my body. I'm inflamed everywhere. My feet are inflamed. I'm in bad shape here. But back here, you see this is indicator towers for sale, $500. You get code. That's it. This is just code. You get the code for this yellow line up here and this indicator down in here, which you could use on Thinkorswim. I programmed myself. Okay, so you have the para up here. It's just basically your visual line, similar to a trend line. I just liked the way they look, to be honest. And you could see that they down here, this is going to drift away from the prior trend and go up. That's how they work. Over here, this is the trade of the day right here. The towers flatten. Okay, this is the more important indicator. This indicator up here is just basically a free gift. I just like it. You don't have to use it. Right here, you see a step down right here. That's your first indication that the trend is breaking. You could see like there's kind of like, I call them like tweezer tops up here. When you see the tweezer tops, that is a pattern which you see in retrospect on this candle. This is the indication that everything is valid. It is a go. You get a bonus that there is a previous pattern where the sell happens. The sell is good. Boom. It happens at roughly, we'll say 693.31. So 693.31. Now what you want to do is you want to find something that's a little out of the money, 1 or 2 points. So you don't want to go farther than 2 points out of the money. So in this case, since you're trading upside down, you want this to go this way instead of it going that way. Okay, so we're going to look at a put option is on this side for Thinkorswim. You have strikes. You have 4 strikes. 1, 2, 3, 4. Okay, the strike prices are the same, but the contracts are different. They're put and calls. So since we're expecting the pattern to go down, we want to look at something like this that is roughly, that's not even $1 out of the money. But look how cheap it is. Back in here, look at the time of the signal. The time of the signal says 1550. So we want to come back to 1550 on the chart. 1550 on the chart. And look at that. You also get a tower signal right there. Look at that. You have a signal, you have symmetry. Look at this. Sell, and then for the options contract, since this is an options contract, you want a buy because it's an options contract. You want the price to go up since it's a put. Okay? So that is the trade right there. You have a sell signal on the SPY, which is the underlying SPY. Then you come over here, you put in your options contract for in this field right here, not that one up there. You put right there, you change all of this over to options, and then you put in SPY, and then you get the strikes. So we're looking at today's date because we're fast traders and we want to get in and out. So 1 or 2 points out of the money at the time of the signal is going to be either 63 or 62. Okay, 63 or 62. Let's take a look at what 62 did. That's the cheaper contract for almost nothing at the time of the signal right there. Okay, so that one is almost nothing. A $5, you have a chance to get this thing for $5 or $10, and it goes up. Look at that, to 40. That is 4x. So you could buy 10 of these contracts for $100 and make 400. That's the potential now. So look at, there's no break in the continuity of this down here. There's no break in the continuity because it's all below zero. Okay, you got the signal. The signal is valid as long as it stays below zero, right? It stays below zero. You have the continuity of the para up here, which is basically is showing that the para is pointing down, right? It doesn't turn and, you know, go against you and start going up. Okay, so you have continuity. You have continuity in the contract itself. You have continuity in that it doesn't signal down until here. Okay, but you want to get out. If you have 4x profit, you're getting out. And then you also can see that this tall tail right here, that is an indication. If you're right here, look at this tall tail. That's a probe after a good size gain. It's probably a good time to either get out or cut your position. And besides for that, the market is closing, so you want to get out of your, you want to file out anyway, because you don't have much time to trade until the close. And you know, of course, you're going to be set up for after hours. You have a little bit of time after hours, but what's the point of holding if it starts to crash? So back in here, you also have the continuity right here. Look, get out, get out. They're both saying to get out. So unlike my other system that works on MetaTrader, the towers indicator, you want it set up precisely 16. I use time frame tick, 1600 ticks. It's a different setup, okay? 1600 ticks time frame instead of minutes. So instead of minutes, you do not want time, you want tick. You want the same setup over here. But for options, you're going to use a faster time frame, 133 ticks. That means for every 130 tick contracts is a bar. It comes out to really good signals. Now this one wasn't. You get cruddy stuff when you look at options contracts. It's not going to look like a SPY contract. It's really hard to find an indicator that trades on options contracts. But this is when it does, you use it for validity, use it for continuity. Okay, you get the signal over here, and then you pull up a contract. Okay, you're like seeing the signal. You have to move fast. You have to move very fast. You're like, I'm getting a signal. You see this thing topping out, right? It's counting down. You already are looking over here and setting up contracts to short, and then you get the signal. You get confirmation back in here. You have to move fast, think fast. Everything has to be fluid. And then you have your contract pulled up, whether it's the 692 or better 693, because it's more in the money. There's more likelihood, but there's more risk because the contract's going to cost more because it's more in the money. So it works. Everything works opposite, and the concepts are all the same, but it works the opposite. If it is a call, in the money means the opposite thing for a call than it does for a put. So we have this contract. The strike prices are in the money, in the blue here, because when the contract closed, it was trading at, I think it was 692 in here. So 692 is actually going to be out of the money for a put, but in the money for a call. You see, it works differently. All these ones that are above 692 are in the money, okay, for the call. Say that right. Let's see. Let's pull up some more strikes. Okay, all of these are in the money, okay, but 693 is up here, so they're out of the money for the call. Okay, but they're in the money for the put because the price is below. Okay, seems confusing. You have to think about it a lot. If you're dyslexic like me, I kind of like overthink stuff like that. But 693 and below is in the money, but back in here, see, you're like in the money back in here at 692. So even if you pulled up to 692, you go in the money briefly. You want to get out of your contract before close if you're in the money, because you have to buy the underlying. Usually the broker will sell you out, so you don't have to actually buy it. They'll liquidate your position, but you should do that manually because you have to buy the underlying just in case the broker doesn't. Okay, so yeah, good trade right here. Buy at 20, get out at 1 is the potential. It did break down a little bit in here, but back in here you did not have a break in the continuity. I mean, you have a break in the continuity between the two, but the signal was still valid. This is a faster.